What if the biggest risk to the US stock market is that it just keeps rising? Lately, we've seen a surreal pattern. Inflation spikes and the market rallies. Employment slows, but the market still rallies. Geopolitical risk reemerges, and yet the market doesn't flinch. In fact, it climbs higher. So here's the question. Is this kind of bullish momentum justified, or is something deeper and potentially dangerous driving us equities? Are we in a rational rally or in a rational cycle? Today on Epoch Report, we unpack a strange but powerful feedback loop that seems to be propping up markets and ask, what could snap this cycle? 3 variables could hold the answer. Stick with us to the end, because what we're about to reveal could rewire your entire view of what's really fueling this market. If you notice the market seems impossible to bring down lately, yes or no? Drop your thoughts in the comments. Let's break this down. This week, all eyes were on the Federal Reserve as it delivered its first rate cut in over a year, a 25 basis point reduction. But let's be honest, the number itself, that's not the full story. The real impact came from Fed Chair Jerome Powell's comments during the post-meeting press conference. Powell described the move as a risk management cut. That language, subtle but deliberate, echoed what he said over a year ago, just before a series of multiple cuts kicked off. When asked if this single reduction could address the economic risks ahead, Powell noted that one should consider the entire path of monetary policy. Translation, more cuts are likely coming. The market got the message. According to data from CME's FedWatch tool, traders now expect 2 more cuts this year, followed by 3 more in 2026. If that plays out, interest rates could fall as low as 3% by the end of next year. Whether or not we hit that exact number, what really matters is that the market is already pricing in a sustained easing cycle. That's the backdrop driving asset prices today. Let's not get carried away by the notion that rate cuts are always bullish for stocks. The truth is far messier. Look back over the last 3 decades. The Fed slashed rates aggressively in 2001 and again in 2008. And in both cases, the stock market struggled. Why? Because the economy was already in recession, and the rate cuts were trying to rescue it. But in 1995, 1998, and most recently in 2019, the cuts were preemptive. The economy wasn't collapsing, just slowing. And under those conditions, stocks performed quite well. So the key question today isn't simply, will the Fed cut? It's what kind of economy are we cutting into? If we're steering into a recession, no amount of easing can truly save equities. But if the economy is still fundamentally strong, or at least stable, a dovish Fed could be a strong tailwind for stocks. Let's dive deeper, starting with the job market. We've got conflicting messages here. On one hand, non-farm payroll data shows a steep drop in net new jobs added since May. But at the same time, initial jobless claims remain stable. And the layoff rate hovers around just 1.1%, suggesting that companies aren't rushing to cut staff. So why aren't employers adding jobs, but also not cutting them? Goldman Sachs has long maintained that 70,000 new jobs per month is a critical threshold. Below that, unemployment tends to increase. So by that metric, we should already be seeing a rise in joblessness. And yet we aren't. The most plausible explanation lies in data from the August manufacturing PMI, leading economic indicator. The PMI surged to 53, the highest in 3 years. That surge reflects genuine demand. Companies are seeing full order books and anticipate continued need for their products. But here's the twist. Because of uncertainty around trade policy, specifically tariffs, many firms say they're holding back. They see the demand, but they're not hiring or expanding capacity just yet. It's kind of hesitant optimism driven by policy anxiety rather than economic weakness has been the status quo for months. What's changed recently is that demand appears to be real and solidifying. If policy uncertainty continues to decrease and demand holds, it's only a matter of time before companies start hiring again. Where exactly is all this demand and spending coming from? To answer that, we looked at consumer data from Bank of America, one of the most detailed real-time insights into U.S. household behavior. In August, credit and debit card spending rose 1.7% year-over-year. July was also strong at 1.8%. Adjusted for seasonality, the monthly spending trend is now up for 3 straight months. That's a sharp rebound from May and June, when spending dipped amid tariff fears. But here's the real nugget: that spending surge is being carried not by average Americans, but by the wealthiest households. Moody's estimates that the top 10% of U.S. households now account for 50% of consumer spending, a new record. Even as lower income groups pull back, the affluent are fueling the consumption engine. Why are wealthy households suddenly spending more in a high-rate environment? Shouldn't economic pressure make them cautious too? Turns out the root cause isn't the economy, it's the stock market. Affluent households typically hold over 50% of their net wealth in equities. So when stocks rally, their sense of net worth increases, even if their income hasn't changed. That drives a psychological effect known as the wealth effect. They don't just feel richer, they act richer. They spend more, invest more, and support more demand across sectors. This explains the sudden dip in spending during Q2, when stocks briefly fell, followed by a strong recovery in Q3 as markets rebounded. Big-name stocks returned to previous highs. Meanwhile, lower-income households who own far fewer equities don't benefit from stock rallies in the same way. Their spending remains constrained by income and inflation. So while the wealthy continue to spend and sustain demand, lower-income Americans tighten their belts. For better or worse, that's what's propping up the current consumer economy. And this brings us to something far more systemic. Put all the pieces together and what you get is more than a bullish phase. It's a self-reinforcing economic flywheel. Stock gains increase wealth for the rich. The rich spend more. Higher spending boosts corporate demand. Companies see steady revenue even in uncertain times. They retain employees rather than laying them off. Employment stability supports broader economic growth. Economic stability further boosts investor sentiment. And we end up with a loop. Stock market gains both cause and are caused by economic strength, at least on the surface. That's why U.S. markets right now can feel invincible. Every setback is another reason to rally. But here's the catch. This loop isn't invulnerable. Let's be clear. Any of these three variables could disrupt the entire feedback loop. First, the Federal Reserve. This cycle is predicated on ongoing rate cuts. If the Fed decides to pause or reverse course due to sticky inflation or geopolitical shocks, the loop begins to weaken. As of now, markets are conditioned to expect a dovish Fed. Any deviation would be a shock. Second, policy risk, especially around tariffs and trade. While negotiations have cooled tensions recently, the risk hasn't vanished. If new tariffs or trade confrontations emerge, particularly from political players like Donald Trump, corporate hesitation could turn into real economic contraction. Third, artificial intelligence isn't just a tech story. It's a key driver of corporate profit among U.S. large-cap stocks. In many ways, AI is the jumpstart battery that's revved up the current market rally. If AI development were to stall or disappoint market expectations, it could severely undermine the earnings that support stock valuations. Now, personally, we remain highly optimistic about AI's trajectory. Technological progress is notoriously hard to stop, and AI evolution often exceeds linear growth expectations. Most analysts still underestimate how fast and how far AI can go. If you've watched this far, then clearly you're not here for surface-level analysis. At Epoch Report, we bring you nuanced, data-driven insights every week, the kind mainstream financial news tends to overlook. If you want to stay ahead of what's shaping our world in your portfolio, click to follow our channel and turn on bell notifications. A 10-minute video could change how you see a market cycle or spot a turning point before it hits headlines. Let's balance the picture. While this flywheel looks sustainable for now, short-term risks haven't disappeared. Take inflation. The past 2 months of CPI releases haven't been great. While it hasn't stopped the Fed from cutting, inflation remains stubborn. If it flares again, pressure could mount to pause rate cuts. And tariff effects are often delayed in how they impact consumer prices and supply chains. As current policy changes trickle down, we might see temporary bumps in the data that rattle markets. But from our perspective, these are likely short-term issues. The deeper structural loop, driven by wealth, equity markets, and corporate stability, remains intact until key variables change. So, where do we stand? The U.S. stock market today feels unshakable because it's being powered by a rare convergence. Accommodative policy, resilient demand, stable jobs, and strong tech-driven profits. But it's not magic. It's a cycle, and cycles can break. That's why we're watching 3 pressure points closely: the Federal Reserve's rate path, shifting trade policies, and the ongoing acceleration of AI, as long as those stay on course. This market, even after a 30% rise since April lows, still has room to run. But if any of those engines stall, the feedback loop could unwind fast. What do you think? Is this market riding on a sustainable loop, or are we one surprise away from a sell-off? Drop a simple yes or no below. Is the wealth effect real enough to keep things going? We read every comment. If you found this valuable, don't just hit like. Follow our channel and turn on bell notifications. At Epoch Report, we're here to help you spot the signals most investors miss before they become front-page news. Timing matters in markets, and the right insight at the right time could change how you invest forever. See you in the next report.